What's up, guys? It's Cash Flow Cart. I'm back in Bloomington. Me and my dog Mia, we moved back last night. Today's Sunday. Kind of got the Sunday scaries, but I wanted to do an old-fashioned stock analysis. Let's get into it. Talked about this one on the channel quite a bit, and rather than trying to sprinkle in how I feel about certain stocks, I need to do like full reviews sometimes. You guys got to bear with me. I post 2 videos a week. So, still figuring out kind of what I want my schedule to look like as far as content. But I'm a 22-year-old dividend investor, and today we are talking about Rowe Price. I'm sure if you've been with me, this is no surprise to you. You've probably seen me go through my position in this one. I've been building a small position in 2023 and then I'm really excited, in 2024 to keep adding, hopefully at around 100 or even lower would be amazing. We're going to talk through it today just using Seeking Alpha, and I'll go through the charts too. I'll show you my entries. First off, this is a dividend investing channel, but we talk about other stuff too, mainly dividends. We'll start on the dividends tab. Rowe Price, as of today, Sunday, January 7th, is yielding 4.6%. That's a pretty attractive starting yield, okay? I see a lot of people on here talk about yield on cost, and they're always referencing things like the compound annual growth rate of the dividend, the sustainability of the dividend. Guys, these things are great, but if we really want to make the most of our money and we want to get that juicy yield on cost, sooner rather than later, that starting yield we lock in is going to be very important, okay? We've talked about it with Apple, all right? Apple is a free cash flow beast. They've grown their dividend semi-aggressively, but right now, as Apple's nearing highs, that dividend yield has been driven down to, I think it's 50 or 55 basis points right now. All right. That's going to take a lot of dividend growth to get the yield on cost type of play we're really after. Rowe Price, 4.6% starting yield. We look at this 5-year growth rate of the dividend, almost 12%. So for me, I see something like this and I'm like, this is 2 green flags. Okay. Again, we're just looking at the dividend right now. It's got a high starting yield relatively, and it's got a pretty aggressive 5-year growth rate. Okay. The earnings payout ratio is 63.78. I've mentioned it before. We typically like to look at the cash flow payout ratio on a forward basis. But, from an earnings payout standpoint, this one seems sustainable. Again, they have that growth rate of 37, or that growth track record of 37 years. That's pretty attractive. It's been through 2008. It's been through, 2000. And they've been growing their dividend longer than I've even been alive, much longer than I've even been a dividend growth investor. You can see they pay quarterly, as do many stocks. Let's not spend too much time here on this tab, but I think it's good to start the video peeking at the dividend summary. We'll go to safety next. As I mentioned before, guys, a lot of people might look at, the earnings payout ratio. The reason I really don't like to do that as much is because earnings can, they can be manipulated, or they can be they can tell not really the full story through different accounting tricks, depending on, when companies are taking expenses, different things like that. I like to look at right here, cash flow payout ratio. That's going to measure the free cash flow a company brings in, how much of that free cash flow is going towards the dividend. Right here for Rowe, it's 50%. The 5-year average is 45%. So it is up, but, we'll talk about some of the lumpiness of Rowe, and we'll explain why. So, with this 50% free cash flow payout ratio, it seems to be a safe and sustainable dividend. We'll peek at the growth. 3-year CAGR of the dividend is nearly 11%. The 5-year, nearly 12%. And the 10-year, 12.5% nearly. So, guys, it's great to look at these numbers. It's great to see, okay, this company has committed to aggressively growing that dividend in the past. That could mean they'll continue to do it in the future, but don't take some trailing metric like this and kind of throw other stuff out the door. By no means is the dividend CAGR, one of the most impressive things. You can even see their 1-year dividend growth rate was not even 4%. So they have slowed down in the 1 year, respectively to that 3-year. Hopefully they can pick up that pace again with how sustainable this dividend is. We will look. If you guys have been watching the channel, I like to look at net income. And all I'm doing when I'm looking at net income is trying to identify a trend. Okay, I understand no investment's going to be perfect. There's going to be no perfect foolproof way to find some fair value, but we identify a trend in net income and we try to identify a trend in free cash flow per share. Let's start with net income. And this brings me to a really good point. Guys, I've said it before. Different type of stocks in different sectors are going to require kind of a different lens, is the terminology I've been using. So, understanding T. Rowe Price obviously manages a lot of retirement dollars, right? They have mutual funds, they have target date retirement funds, 401k plans. So with that being said, a lot of their net income and free cash flow as well, it's going to be dependent on, okay, when are people retiring? Okay, population demographics, age demographics are going to hit T. Rowe Price. And that's not something we'll see in other companies we talk about, like Coke. All right. There's not some day where you stop drinking Coke. It's nothing like that. But with T. Rowe, the greater population trends are reflected in T. Rowe's financial statements. And that's, that's where the lens I talk about with different stocks kind of comes into play. So, we look at their past 5 years of net income and we don't see some perfect trend, right? December 2021, 3,000, whereas trailing 12 months, which is 2023, 1,600. Okay. It's difficult to identify a trend here, but with my personal risk tolerance, I'm okay with this. I understand the risk of, an aging demographic. I understand that retirees are taking RMDs. They're taking funds out of, their T. Rowe managed portfolios and their 401ks. Another thing I'll mention here before we move on to free cash flow with this one, and I've said this before, guys, while this may seem like kind of a drawback, the lumpiness of their income, there is also a plus to this. And that is a lot of retirees or people saving for retirement at any age who are partnered with T. Rowe, they're not going to want to make any sort of drastic type of changes. Okay. I'm trying to explain this, in very plain English, guys, because that's kind of what I'm about. But let me ask you this. If you have, if you're working all the time, let's say you got a wife and kids, you're saving for retirement, you're a busy guy or a busy girl, are you going to want to worry and are you going to want to actively manage your retirement dollars? Are you going to say, oh, do I need to move my retirement money here? Okay, you might, but more than likely, your retirement savings are going to be kind of a set and forget, a plug and chug type of thing. Like, a lot of companies with T. Rowe manages their 401ks, the 401k savings is coming out of their paycheck. There's nothing the employee has to do. Okay. So this may be long winded, but this creates a very sticky type of business. Okay, guys. I mean, some people middle aged and younger, they quite honestly might have never even logged in to check on their retirement dollars. And, this creates a very sticky type of business for TROW. And, that's the main source of, where this one gets kind of its wide economic moat. Okay. It's not even just consumer preferences. It's more consumers. They're here. They're staying here. Okay. I thought that was an important point to get across. Before we move on to free cash flow per share, I've talked about this metric a lot here, guys. We'll just read through it here. Free cash flow per share is a measure of a company's financial flexibility that is determined by dividing the free cash flow by the total number of shares outstanding. Oh my gosh. Very important here, guys. I can't highlight it. Shares outstanding. Okay. Why do I like to use free cash flow per share? Because it's on a share outstanding basis. Okay. And these shares outstanding are going to be the shares that TROW pays out the dividend to. Okay. So if I can identify a good trend in free cash flow per share, okay, I kind of kill two birds with one stone, I've said before. All right. This number here, the free cash flow per share, is essentially what needs to support, their annual dividend payout. So if we can see this number grow faster, if we can see it grow on a more aggressive uptrend, that could be an indication that the dividend could follow. Okay. Very important metric to understand here. And definitely one of my favorites. Okay. If I just look at total free cash flow in a company, and then I'm looking at shares buybacks and shares outstanding, I don't know about for you guys, but for me, it's hard to, wrap my head around the full story as a dividend investor if I'm trying to use, two separate metrics and see, okay, how's that going to affect me as an investor? It's a little easier to use free cash flow per share. Again, not a perfect trend here on this one either, but, that dividend has been very sustainable. And we did mention why a company like T. Rowe Price is going to struggle to have some perfect uptrend in some of their metrics. Let's move on. What else do we want to look at? I think it's been a couple videos since I've talked about valuation. Maybe I've gone through the charts, but I will show you kind of my favorite way to determine if a company is a good buy or not in kind of a relative 5-year window. You guys guessed it. We're going to look at, free cash flow again. One of the most important things to dividend investors is free cash flow. If you want to drive that point home, Warren Buffett's got some great content out about it, I'm sure. Charlie Munger and Warren Buffett, they're always talking about cash-rich businesses are much easier to understand. So, we love free cash flow because that's what's going to sustain our dividends. Let's not get too deep into a tangent here, but I like to look at, and this is pretty much exclusively, the only kind of two valuation metrics I use are dividend yield and price to free cash flow. Okay. And dividend yield, I don't know if it's always a perfect valuation metric. I guess it does kind of tell the story, but my favorite is price to free cash flow. Right now, T. Rowe's price to free cash flow is 11.11. Okay. And kind of how I'll wrap my head around the story is by comparing it to that 5-year average of 13.57. Okay. If you're using Seeking Alpha, it'll even tell you negative 18.14%. Their current is 18% lower than their 5-year average. And kind of the story I read here is, okay, within the past 5-year window, maybe TROW is at an 18% undervaluation. That represents, a potential buying opportunity. That's kind of how I do this. We already looked at dividend yield, but if you like to use that for valuation, you can see the 5-year average is 3.1. Okay. So the way you would do, the way you'd identify opportunities with dividend yield, again, which I usually don't really do, it's going to be taking that current yield, comparing it to the 5-year average and seeing, okay, how much bang for my buck am I getting right now, compared to on a 5-year average. You're getting a 48.46% higher dividend yield entering TROW today than the average of the past 5 years. Okay. So both of these things could represent, buying opportunities. Guys, if you like to use any other valuation metrics, let me know. Price to sales, I've looked at before. Price to book, I've done some real basic studies on. But for me, the best thing has been price to free cash flow, and we talked about the dividend yield. But last thing we're going to look at here is that net income margin. Right here, 25.5%. And I will say this, I don't have some specific number that a net income margin has to exceed. It could be different based on sector. However, you want to stay away from stocks with too small of a margin. So in a previous video, we talked about, Walgreens, how their, net income margin was less than 1%. All that says is they don't have a lot of wiggle room. Okay. If they have a 1% net income margin, okay, next year, if something goes a little differently, all of a sudden they're going to have to report a loss. I feel comfortable with TROW's net income margin of almost 26%. The 5-year average is 34 and change. Obviously, we don't like to see it down from the 5-year average, but we've talked about the lens I'm kind of using with TROW price, and it is going to be to kind of expect that lumpiness in cash flow and income. All right, this could be enough yapping on the Seeking Alpha site, guys. Let's go ahead and peek at their charts, kind of talk about my plan. I've probably done this a little bit on the channel already, but we'll go through it again because it is relevant for this video. So I currently have 7 shares at an average price of $100.42. I mean, that puts me up for an open profit of $40. Not really too worried about that in the short term. I would obviously like to hold this one for a very, very long time. So, you can see my entries here on the weekly chart. I've got this line kind of drawn at 100 just because I was kind of interested to see if that $100 mark would act as kind of, a mental support level. People say, oh, I'm buying it when it gets to 100. And sometimes kind of those psychological levels can act as a support. TROW did break down 100 very briefly. Now it's come back above it. If it continues to fall towards this 80 mark, between 80 and 90 or low 90s, I will be buying, very aggressively. Otherwise, if it stays kind of between 80 and 120 and consolidates throughout 2024, I'm going to keep building this position. I'd like to turn it into kind of a medium-sized position to me. We've got a long way to go. I don't know, what my share kind of goal is for the total number of shares, but as long as this one stays attractive and as long as I continue to focus on my own conviction, I'm definitely going to build this one out to be a bigger position. So that's my plan for this one. TROW price. Let me know in the comments, guys, if you guys hold this one, if you're interested in holding it, if you disagree with anything I said. Guys, I'm open to all of that stuff. I'll try to reply to every comment I can. And thank you so much for tuning in today. If you're subscribed, even more thanks. And if you want to subscribe, feel free. I've got new dividend investing content coming out on Mondays and Thursdays at 1:30 p.m. That's the plan. That's the schedule. We're sticking to it, guys. Everyone have a great rest of your day. And thanks for joining me.